Today, we're going to talk about frequently asked questions that Dan and I get asked all the time. So what we're going to do is I'm going to ask Dan some questions, and if we have time, he'll ask me some of the other questions that we get asked on a regular basis. Now, remember, if you have a financial advisor, please check with them on any information, because Dan and I are just giving our own opinions. We will have our disclaimer slide at the end of the presentation. Anyway, so we're here today and we're going to start asking some questions. So one of the top questions, Dan, that we get asked a lot, especially right now, is with all the volatility and the stuff going on in Russia, between Russia and the Ukraine, people are concerned about their portfolios and they're wondering if they should make a change. How do you answer that?
Well, Linda, thanks for being here with me as well. This is a very difficult and tricky question to answer, and it's one of those it depends type answers. There is a lot going on in the world right now, for sure. We've written a few emails prior to, I guess, the end of last year, expecting an uptick in volatility pre-Russian invasion of the Ukraine. It was kind of just based on the excesses in the system, from money supply to debt, low interest rates. We knew interest rates would at some point have to creep back up. A lot of stretch valuations, especially in the tech sector, with some of those, let's say, stay-at-home trades, and then the reopening trades in addition to those. And then, lo and behold, Putin takes a Russian army and invades Ukraine. And we are already kind of in a rocky scenario in January, and this has certainly added to the level of uncertainty. So with all that said, should I be concerned, or should clients be concerned? Yes, but not overly. It's one of those things. Hopefully, if you're like our clients, you've built let's call it a diversified and balanced portfolio to hopefully weather some of these downturns. Kind of the shorter your time horizon, maybe a little more concern is warranted. And the approach we take, with those type of clients is, of course, to reduce risk in the portfolio accordingly. So, each situation with each client is unique. Younger clients that have a long runway to retirement or whatever they may need that money for, should be a lot less concerned and keep, as we like to say, dollar cost averaging into their accounts and their positions. Volatility is great for people that are continuing to add to their accounts, because you're buying in potentially at lower costs. Your dividends are getting reinvested at some good prices. And if things go lower, again, you have a lot of time to make that back. We kind of really just looking, and this was our opinion even last year, was we cannot expect 8, 9, 10, even 15 and 20% returns year after year. It's just not possible. The market overall tends to not grow phenomenally faster than GDP growth. The long run track record for the markets is 10% and shrinking. I think it's actually closer to 8 or 9%. So there's this thing called mean reversion, where if the market's been averaging 8%, 8%, and all of a sudden we get 15 and 20 and 30% year returns, you have to expect much lower returns for the next little while. And that next little while is such an unknown. Is it 2 years, 3 years, 5 years? It's really, really difficult to say. So our approach is to try to reduce concern through diversification, and balancing out the portfolios, and really trying to tailor it to each client.
You did mention something and that I picked up on, and in case our audience didn't, but one of the things that you mentioned was the dividends and the dividends reinvesting over this period of volatility, which would help add to the performance and I'll say kind of protect on the downside. So if people are retired and they have a lot of dividend paying investments in their portfolio, do they really need to, because nobody knows the end of our time, but do they really need to sort of panic and maybe want to go to cash? Because we do get people asking whether or not should we go to cash. And you've kind of said also that, you know, if you had cash, it's great because you get to dollar average in right now during this period of volatility. But again, what do you say to those people that are fully invested right now, don't have the extra cash, and their time horizon technically is long term because, you know, they don't know if they're going to die in 1 year or in 30 years?
Well, no, listen, no one knows their future timeline from that perspective, Linda. I, and you know this, love dividend paying stocks. You know, I do love technology, but a lot of these companies get overhyped and their valuations get stretched, and they are a lot more volatile. So, you know, we do have some of that in our portfolios, but for the most part, we do like to have those dividend payers. And my preference is to leave them and either take the cash from the dividends or let those reinvest and not try to time the market. I mean, it's I sat, you know this, I sat at a trading desk for over a decade, looking at 6 monitors with stocks and indices and everything. It's very hard for a professional who's doing this all day long to time short and long-term trends and reversals. Getting out makes it almost impossible to get back in. You know, and when things are low, they can always go lower, and vice versa. When things are high, they can go higher. And you know, there's that saying: the market can remain irrational longer than most people can remain solvent. You know, if you pick really good investments, I that can weather these kind of volatile periods, I think that's all you can do. I don't know about timing and guessing and any date or situation.
So during these times, would there be sectors that if clients could come up with some extra money that they might want to add to positions just because, you know, a lot of times you hear war brings fortune because certain things will start to happen where whether it's technology or AI or something throughout the war, all of a sudden these companies are now taking off where they might have lagged. For example, we're seeing a big hike in oil prices. And I remember when oil prices were below $50 and now they're over $100 a barrel. And, you know, should people want to get into on some of this stuff, or is it basically already been priced into the market?
Yeah, again, that comes back to timing, which in my opinion is next to impossible. If you know, the time to buy oil was back when oil was negative at the start of COVID, and take the bet then, you know, maybe being a little counterintuitive to the crowd. As far as like picking stocks for what they're doing now is very hard. The market looks forward, you know, 12 plus months, or tries to, and that's the dynamics of the constant pricing mechanism. So I'm not a fan of trying to time. Oil's, you know, hits $130, 130, and before the end of the day is back at 118. You know, the oil stocks are looking further out. Could they go higher? Sure, but who knows? Defense spending probably going to go up, but again, some of this is already priced in by investment professionals. So then you could be, you know, counter trend by the time you actually look to get in. And this is where the diversification comes in the first place.
So that's why because sometimes, and you know, Dan, we've had clients, they look at their portfolios and some things are down and some things are up. And they say, well, should we get rid of that that's down and actually go buy more of something that's gone up? This is kind of what you're talking about then, is because eventually it turns around and that thing that was down is part of the diversification. It's good now because now that's gone up and something else has gone down.
Yeah, and well, and that also applies to, let's say, the fixed income component of a portfolio, which may have been down slightly from rising rates. But when the market goes volatile and choppy like it has during this period or in March of 2020, I mean, for the most part, the fixed income portion doesn't move, and that's why some of it is there, and things will move counter-cyclical, counter-trend. You know, and you do want to have those in your portfolio for these reasons.
So overall, even though it's a scary time for a lot of people with this, you know, Russian invasion, they really should just basically, you know, focus on the long term with their investments and not panic and do some emotional trading.
Yeah, that's kind of my opinion, and I assume it's yours as well. But yeah, I don't really subscribe to that mentality. And I know it is stressful to watch your account value. I have an account, as do you, go up and down. And I feel it when you know, when the markets are negative. But my philosophy, like I said earlier, is to keep adding monthly and averaging into the positions.
Okay, so on another topic that we get asked a lot about, and it's everywhere on the media, is cryptocurrency. And I saw a headline this morning where they were talking about, Biden was talking about having, I guess, a cryptocurrency. What impact would that have on people? Just in the sense of investments or usage or whatever. Can you talk a little bit more about cryptocurrency and put it in a perspective? And I know we've written an article, you have actually, on cryptocurrency, but for those in the audience that haven't read the article, can you talk a little bit about cryptocurrency and sort of the future of what's happening?
Well, the future, like we said earlier, you know, that we'll see. But you know, cryptocurrencies, in my opinion, do have a place, and I kind of get it. Let's take Bitcoin, for example. Bitcoin was created with a finite supply of these units. There is no chance of government manipulation or involvement in that platform. And that is the appeal. I mean, it started to be very appealing to, obviously, drug smugglers and mafia figures and whoever wants to embezzle money at the start. But, you know, the uses have become kind of more mainstream. And as we look at, like, the Canadian government or the American government, for example, and how much money they've basically printed in the past year, like, I believe in the past year, they've printed almost as much money as the previous 30, which is, you know, you can look at supply crunch from COVID and whatever, but the inflation we are experiencing, a lot of it is what's called a monetary phenomena. And a lot of it does have to do with the excess in the system, you know, whether it's home prices or other real estate or different assets. So then you look at things like Bitcoin, where there is no government intervention in the supply and demand of it. They can't create more. It's outside of any, you know, regulatory perspective, for better or worse. The good thing with the cryptocurrencies is they're backed by this technology called blockchain, which allows or doesn't allow for fraudulent and duplication and counterfeiting. It's actually a very secure way of stacking data. So with that in mind, you know, it kind of makes sense that there's a place in the world for digital currency, and it's likely to grow as governments take these steps to devalue their own currencies through foolish policy or overzealous. I mean, That's I guess one way to put it.
So a lot of people, and I'm going to say a lot of average people with modest investments want to get into cryptocurrency. Is it high risk, or is it because it will become mainstream pretty well on the lower risk side, like a bond?
No, it's definitely not even close to low or even medium risk. Our compliance department labels it high risk. I mean, I don't like these high, low risk kind of monikers that you attach to stuff. It's a personal view. I think for many people's portfolio, it could have a place. The way we've invested for clients in the past is through owning it through ETFs, although you can own them directly. But there is a place, I think, in portfolios for it. The problem with it, kind of like holding gold, it doesn't produce income. It's kind of like just holding US dollars. And then what, So I think that needs to change. So if we can get to a place where there's crypto accounts that pay you interest in that cryptocurrency, or we can invest and receive income, then all of a sudden this becomes more widely acceptable in my view. And I believe that's starting to happen in some of these crypto providers, like the platforms.
Thank you. Okay, so right now with interest rates on the way up, are bonds a good place to actually put money for safety now?
So, I mean, you have to pick your spots. As far as safety goes, bonds traditionally much more safer and stable than stocks. Although over time, as you lengthen out your time horizon, volatility in your equity portfolio tends to fall dramatically. We include bonds in our portfolios for that safety, though. The black swan event that's always potentially around the corner. I think you need that there. And if you look, and this is like, if you look back 100 plus years, portfolios that have had at least 20% fixed income and 80% equities have for the most part outperformed all equity portfolios with a lot less risk. So you really can reduce the kind of volatility in an account just by adding a little fixed income without giving too much on the way of upside.
If a person didn't really want bonds, especially right now, what would be some alternatives that you could recommend?
So what we're doing, I mean, we're using preferred shares here. They do pay a higher dividend, and in non-registered accounts, you get the dividend tax credit. But we are really looking at adding alternatives to our portfolios, such as funds that can go long, short. And what that means is they can bet against the market. And what that enables some of these providers to do is provide steady returns with very low correlation, or like doesn't move with the market. And it's hard to get zero correlation, but you can reduce it. The trick is finding a provider that does this for a reasonable fee. And right now, a lot of these are what's called OM, offering memorandum for high net worth clients. And we're looking for something with broader appeal, but those are some of the things we've been adding to our portfolios.
Just because I didn't ask you this when you were talking about crypto and kind of like gold, because it doesn't pay any kind of interest, would you still put gold in a portfolio at this point?
Gold in and of itself, me personally, no. I mean, if a client said they wanted gold, I would suggest they buy ounces and put it in their safety deposit box so it doesn't, get stolen from their mattress. I would prefer to buy gold stocks, silver stocks that pay, again, dividends that can grow with the price of gold. Gold ETFs. There's one that I really like that sells options against the positions and has a nice yield. That's the approach I would take. Yeah, but as far as like straight up holding of gold, you know, it wouldn't be a bad idea to have some in the worst case scenario, if you were worried about that. And crypto to some extent has supplanted some of that need for gold in the markets, but as the last few weeks have proven, it's not the perfect disaster hedge that I guess people were anticipating.
Got it. So when you're looking at a client right now and they're getting closer to retirement, say within 5 years, how would you structure the asset allocation for especially now knowing what's going on in the world and people being nervous, how would you structure the asset allocation? And then how would you make that change when the world seems to be a little bit more calm? Because there's always something going on that might impact the portfolios. But right now, as we're taking on new clients and you're looking to invest this new money, what are you kind of looking at in the sense of, like I said, the time horizon, the age, but say they were within 5 years of retirement, like as far as percentages?
Well, as far as the world goes, again, excuse me, this comes back to timing the markets, which we already said is very difficult. But we have kind of been increasing a little bit our, let's say, cash alternative position. You know, we've been adding a lot to low risk funds that pay us money. I don't like to leave idle cash. There's very little point to that. You know, a lot of people leave that money in their bank account and it's doing nothing for them. And depending on the client and how much money they have in their wealth, you know, we would build the portfolio accordingly. I always try to have at least a minimum of 20% fixed income, and take it up from there. You know, if the client needs the income, it creates a bit of a dichotomy of, you know, it's challenging because then you need to take on a little more risk and explain that to them. And then you have the little downside in there, but the risk will provide additional income. So again, it's case by case, but we, you know, as clients do near retirement, we do tend to pull back a little on the risk. And like I said, given what's happening in the world today, we've kind of, you know, taken a little bit off the table and are putting it into just let's call it cash holdings, but things that are paying us. And I mean, that's really all we can do. As far as the rest of the allocations go, we keep it pretty diversified. Try to follow, you know, like a pension plan type model.
So that's quite interesting. Can you explain what would be inside your portfolio? For example, are you using the individual securities as well as mutual funds and exchange traded funds? And if you are, where would the bulk of the money be within that portfolio? What are you kind of looking at now to help keep it balanced, but I'll say sort of protected?
So we use everything. We use mutual funds, individual stocks, ETFs, and even some what's called liquid alternatives. And just alluding to what I said earlier, you know, we keep it pretty diversified. There's no one holding that would dominate inside the portfolio itself. And as far as geography and sectors, really everything. You know, I guess I shy a little bit away from emerging markets, although they do have a place. But maybe that's one area that we don't have as much of as we could. But I don't think we miss too much by not being in that space.
That's good. Is there anything, Dan, that you'd like to at least tell the audience in the sense of when they're out looking for an advisor, and what they should be aware of, because there are some people out there that promise these high returns, but with it, they're not always being explained all the risk. But what should somebody that's looking for a new advisor, you know, be aware of when it comes to the investment part of it?
Yeah, for sure. I mean, the advisor role is a bit tricky, and it's I guess imagine very even trickier for the potential client. There's a sales component to the job, you know, and there's incentives to bring in new clients, etc. So some advisors may oversell their capabilities or promise certain levels of return, although probably never in writing. I would shy away from anyone who's telling me what am I going to do with all this money they're going to make me, which is what one advisor told my mom, believe it or not, years ago. You know, I would also look at their credentials, background, experience, et cetera, et cetera. You know, and really, I know we have COVID still lingering, I guess, here, at least in Canada, but you know, you do want to, I think, meet in person and just get a sense of it, their competency and professionalism, and then can you work with this person?
That's very good. And Dan, thank you, because this was very, very informative. I know that, you know, we work together and I know a lot of this stuff, but you really are an expert in the investment realm. And I thought today, from the frequently asked questions that we get, I would stick with the investment side. And what we can do for another masterclass, maybe we can get into the other questions that we get asked all the time when it comes to, you know, CPP and different things like that. But today, this was really, really good. And if you're interested in finding out more, especially about the investments during this time of volatility, you may want to reach out and contact either myself or Dan. We have our contact information that we're going to put up on the screen here at the end. But please visit us, visit our calendar, book an appointment. It doesn't cost you anything, but Dan can actually look at your personal situation and advise you a lot better. Right now, we're giving you general information because people are concerned on what's going on and whether or not they should be sitting idle or actually looking at their portfolio and making major changes. And it depends on your own personal situation. So give us a call and we would be happy to look at your portfolio. No obligation, no charge, and we're not going to be hassling you because we want to work with clients for life. So we thank you very much for this time, and we'll see you next month at our masterclass.
All right. Thank you, Linda. Thanks, everyone.
Thanks, Dan.
Bye.
Bye.